So you might have seen a bunch of crazy fixed rates that are out in the market at the moment. I'm talking 2.1, 2.2%, which is just insanity. But before you rush out there and go fix your home loan rate, I'm gonna take you through 7 questions you wanna ask yourself before you fix, including one that could literally cost you thousands. All right guys, let's dive right in. So it's a question that I've been asked a bunch of times this week. You might have seen it advertised, and there are some fixed rates that are crazy low at the moment. So is now the right time to fix your home loan rate? Listen, it could be, depending on your situation, which is why I'm gonna run you through these 7 questions you need to ask yourself before you go down and fix that interest rate. So question number 1, are you intending on selling that property during the fixed rate period? Now you've got to remember, with fixed rates, there are early repayment fees. So let's say, for example, you fix your interest rate for 5 years. If after 3 years you decide to sell your property, you will have early repayment fees or fixed rate costs for year 4 and year 5 that you would have otherwise had that fixed rate. So it's really important to think about this. And if there's a chance you're going to sell your property or want to refinance it during that fixed rate period, then maybe fixed rates aren't a good idea for you. The second question you want to ask yourself is, will you want to access equity or potentially refinance during the fixed rate period? Now, for a similar reason from number 1, there are early repayment fees. And if you need to refinance or change that loan, you can have early repayment costs. The third question you need to ask yourself is, do I want an offset account or redraw? Now, typically with a fixed rate, you can make some additional repayments, but you can't redraw them back out. And it's the same with an offset account. Some banks simply don't offer an offset account against a fixed rate, or they offer a pretty rubbish partial offset account. So with a normal variable rate, if you've got $100 in an offset account, it will reduce the principal of the loan by $100. So it's gonna save you money on that. With a fixed rate, with some banks, they offer a partial offset account. Or instead of it being a 100% offset account, it's 40%. So that $100 will only reduce the principal by $40, and it's not as effective. The fourth question you want to ask yourself is, do you want to make extra repayments to the loan? Now, with a lot of banks, you are limited in the amount you can make in additional repayments when you fix your loan. This typically ranges from $5,000 to $10,000 per year. So if you're looking at aggressively paying down your loan and putting extra in there to pay it off instead of over 30 years, over like 10 or 5 years, then fixed rates might not be a good option for you, because if you pay more than that $5,000 or $10,000, depending on the bank, they will charge you early repayment fees. The fifth question is, what kind of a split between fixed and variable rates do you want on your loan? Now, you can possibly use a 50-50 or a best of both worlds approach with your fixed rate. So let's say, for example, you've got a $500,000 loan. You don't have to fix the whole $500,000. You could do $250 as fixed and $250 as variable and still get the advantages of an offset account and redraw and all that fun stuff. But it's an important question to ask, because if you're really worried that the rates are going to go up, or if you really want to make extra repayments, then maybe you want to do more variable or more fixed. You're just going to have to do the figures yourself. Everyone's situation is going to be different. Question number 6 is how long you should look at fixing your interest rates. Typically, you can fix between 1 to 5 years in Australia. So if you think the rates are only going to stay low for 1 or 2 years, maybe you look at fixing for 2 years and then just let it go variable after that. Or you think the rates are going to jump up in the next while, maybe you're going to fix for 5 years. Again, you need to factor in your personal situation. If you're thinking maybe I'm going to get married in the next couple of years, maybe I'm going to have kids, maybe my situation will change, then a 5-year fixed rate might not be as good for you. Probably chat to your mortgage broker further about that and see what's going to work in your situation. The 7th and last question is, if interest rates go down further, what will a fixed rate cost me? Now it's an interesting one. With the variable rates in the 2s and our cash rate currently at 0.25%, how low will they go is the question. And one that I don't really have the answer for. It's gonna be up to you. A lot of commentators in the market really don't know, and it's just gonna come down to your personal situation. I think fixing the rates really comes down to a balance of, if you want to make extra repayments, then maybe variable's a better option. But if you want certainty of repayments, then fixed is certainly one for you. And an obvious disclaimer, this is general advice only. This is not taking into consideration your personal circumstances. But that's it for today, guys. Hope you liked the video. If you've got any questions on fixing or leaving as variable, make sure you hit us up or leave a comment below, or get in touch at huntergalloway.com.au.